Can the SBI Life Smart Elite Plus plan protect your family's financial security and safeguard your financial future? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goal in a more faster and smarter way. So now what is SBI Life Smart Elite Plus plan? So before analyzing this plan, let us first understand what is it about. So this is an individual unit-linked non-participating life insurance savings product, and some of the key features of this policy are: you get the twin benefit of insurance cover and market linked returns, and there are two protection options which are available: the gold option and platinum option. And there are also inbuilt accident benefit, which includes accidental death benefit ADB and accidental total and permanent disability benefit, which is ATPD benefit. So these benefits are also available, and you get enhanced wealth creation opportunity through 9 varied fund options, and there is no premium allocation charge from the 6th policy year onwards, thereby enhancing your fund value. And there is also switch and redirection facility available to pilot your investments. So these are some of the features of this policy. Now let's take a look at the benefits of this policy. So there are two benefits. One is death benefit, another is the maturity benefit. So the death benefit differs among the gold option and the platinum option. So death benefit is basically in the unfortunate event of death of the policyholder, the beneficiary will receive the following benefit if in case they have chosen the gold option. So as you can see in the screen, under the gold option there are three options, right? Like fund value as on date of death, and some assured less your applicable partial withdrawal, or your 105% of the total premium the policyholder has paid up to the date of death. So out of these three options, whichever is highest in value at the time of death of the policyholder, that will be given as the death benefit to the beneficiary. So in platinum option, it's between these two options. It's either your fund value as on date of death, or your 105% of the total premium paid up to the date of death. So out of these two options, whichever is highest in value at the time of death, that will be given as a death benefit to the beneficiary. So as I have previously mentioned, the accidental death benefit and accidental total and permanent disability benefit, this is an inbuilt feature in this policy where the accident benefit sum assured is equal to the sum assured under this product, which can be subject to an overall cap of 50 lakhs per life. And under the maturity benefit, basically you get maturity benefit once your policy matures, right? So the maturity benefit here is the fund value as of date of maturity, which will be paid as a lump sum to the policyholder. So these are all the benefits available under this policy. Now let us take a look at the 9 varied fund options available under this plan, which are equity elite fund, balanced fund, bond fund, money market fund, bond optimizer fund, pure fund, mid cap fund, corporate bond fund, blue chip fund, discontinued policy fund. So all these fund options are categorized according to the asset allocation they have to equity and equity related instruments, or what kind of percentage of allocation they have to debt instrument or money market instruments, and also according to the risk profile they are categorized into. Like it could range from low to high. So according to what kind of asset allocation you want to give to your investment and what kind of risk tolerance you have, you can choose the fund options based on these factors. So now moving on, as a ULIP policy, there will be charges you need to pay while being under this policy, right? So there are we are going to take a look at the charges under this policy. So first is the premium allocation charge. This charge shall be deducted from your premium at the time of receipt of such premium. So the allocation to unit is made after the deduction of the charge from the premium receipt. Next up is the policy administration charge. So this is a monthly policy administration charge which shall be deducted by cancelling units at the prevailing unit price on the first business day of each policy month. So if you have opted for a limited pay policy, If you have opted for a limited pay policy, it will be 100 rupees per month, and if you have opted for a single pay policy, it will be 50 rupees per month. And there is something called fund management charge as well, which is a charge for managing your fund. So basically it depends on what kind of fund you have chosen. So the fund management charge differs according to the risk profile those funds have. It can range from 0.25% to 1.35%. There is also something called discontinuance charge, which is charged by calculating the percentage of your single premium or fund value, and it will vary according to the year you choose to discontinue from this policy. And the partial withdrawal charge is a 100 rupees charge, which will be applicable for every partial withdrawal in excess of one free partial withdrawal in the same policy year. And the switching charge is also 100 rupees, which is applicable for every switch in excess of two free switches in the same policy year during the policy term. And mortality charge is given to you, is charged for providing you with life cover. So this is deducted each policy month from your fund value by way of cancellation of units, and this is charged based on your age and sum at risk. And there is also something called the accident benefit charge, which charges 0.60 rupees per thousand sum assured, which will be deducted on a monthly basis by cancellation of units. So the thing with these charges are, your entire premium is not immediately invested in the chosen fund option. Your portion is deducted to cover various charges first, and only then the balance is directed towards your investment. So this overhead cost can reduce your overall investment returns over time, which can be a important drawback to this policy as well. So now let us take a look at the advantages and disadvantages present in the policy. So let's start with the advantages. The nominee here has the option to receive your death benefit payment in installment during the settlement period. And there are two fund switches per policy here, allowed at no additional cost. Premium redirection is also available starting from the second policy year. And partial withdrawals can be made from the sixth policy year or upon the life assured reaching the age of 18, whichever occurs later. So the disadvantages would be, there is a 5-year lock-in period in this policy. There is no loan facility available under this plan, and only after applicable charges are deducted, then your net premium is invested. So the life cover provided by this plan may also not be sufficient. So these are also some of the potential drawbacks you can get from investing in this policy, which you need to carefully consider before deciding to invest in this policy. Now, as we have a basic understanding of what is SBI Life Smart Elite Plus plan is about, let's move on to analyzing this policy. So what we are going to do is, we are going to conduct a IRR analysis, internal rate of return analysis of this policy based on the benefit illustration provided in the policy brochure. So why we are going to conduct this analysis is purely because no matter what benefits or advantages a policy might give you, what matters at the end of the day is the returns you get in your hand. That's why we are investing, right? So that's why we are going to calculate the IRR of this policy. So let's just assume for calculation purpose that a 30-year-old male invests in this policy with a sum assured of 17.50 lakhs. So the policy term is 20 years and the premium payment term is 10 years with an annual premium of 2,50,000 rupees. So at the end of the policy term, the accumulated fund value is payable, and the brochure projects returns assuming investment growth of 4% and 8% to indicate the worst and best case scenario. Because this plan actually is based on market linked investment, right? So market is unpredictable, which can range from best to worst. That's why they have given us two assumed investment rates like 4% and 8%. But it's important to note that these returns are just for calculation example purpose, and they do not represent the entire range of your potential outcome. The actual maturity benefit of this policy will depend on the plan's performance over time, which is not guaranteed. And also, so now if you take a look at the 4% return, the estimated fund value of this policy is 35.14 lakhs, which results in an IRR of 2.21% as per the SBI Life Smart Elite Plus plan maturity calculator, which is equivalent to or similar to a rate of return you can get from a savings account. So if you have not invested your money anywhere all these years, and you have not taken the risk by investing in a market linked investment especially, and kept your money just in a savings bank account, still it would have given you a slightly higher return. So what is the additional benefit, or even where is the risk adjusted return you can get from this policy? We are investing in this policy essentially for the better risk adjusted return, right? But it's not giving us, but this is for the worst case scenario. So what about the best case scenario? In the best case scenario, the estimated fund value is 64.01 lakhs, resulting in an IRR of 6.15% as per the SBI Life Smart Elite Plus plan maturity calculator, which is a return comparable to a debt instrument return. But here we are investing in equity and market linked instruments, especially for a better risk adjusted return. So if you do wanted a debt instrument kind of return, which is guaranteed at least in that case, we could have opted for a debt instrument, right? But we are opting with risk for better risk adjusted return, which you are not getting from this policy. So these returns are suboptimal for a long-term investment strategy. A market-linked product offering such low returns does not provide us adequate value as investors. Furthermore, the sum assured here is insufficient to meet a family's future financial needs, making it inadequate as a life insurance solution. So, in a nutshell, the SBI Life Smart Elite Plus plan falls short in delivering competitive returns and sufficient insurance coverage, making it ineffective in both its investment and protection aspect of the policy. So, now as we know it's not giving us a desirable outcome, what we are going to do instead is we are going to conduct a comparative analysis. So where we are going to compare the SBI Life Smart Elite Plus plan with other investment options or other alternative investment strategy. So what we are going to do is we are going to explore two alternative scenarios using the same parameter from the previous example, where the only difference is we are going to separate the insurance and investment component and invest in it separately instead of investing in a insurance cum investment policy. So under this, for example, for life coverage, we have opted for a pure term life insurance policy with a sum assured of 17.50 lakhs, which cost us only 10,800 rupees premium annually for a 20-year policy term with a 10-year premium payment term. But in contrast, the SBI Life Smart Elite Plus plan required an annual premium of 2,50,000 rupees. So by choosing a term policy, we can save up to 2,39,200 rupees each year, which can be invested separately according to our risk appetite. So for this comparison, we have chosen two options. So for a conservative investor, we have chosen debt option like PPF, Public Provident Fund, which is a government-backed fund giving you guaranteed returns, and it also gives you tax benefits under Section 80C. And if you are a risk-tolerant investor or aggressive investor, we have considered an equity investment such as equity-linked savings scheme ELSS, which according to its track record, you can see that if you invest in it consistently for 7 to 10 years, it has potentially and has proven in certain scenarios that it can beat the average 12% return as well. So based on these, and it also has tax benefits. So based on these factors, we have chosen these two options for two different risk averse and risk tolerant investors. So in the PPF scenario, with a 10-year contribution period, adjustments are made in the last few years contribution to meet the minimum investment period of 15 years under the PPF. So the maximum annual limit is 1.5 lakhs. Although the surplus exceeds the threshold, this is just for calculation purpose. So the estimated maturity value here is for 70.60 lakhs, while the IRR is for 6.80%. So this is higher than the 8% return scenario of the SBI Life Smart Elite Plus plan, despite PPF being a debt instrument, and here the 6.80% is also a guaranteed return, which is not the case for SBI Life Smart Elite Plus plan. And here in the ELSS scenario, you can see the pre-tax maturity value is for 1.46 crore, while the post-tax maturity value after accounting for the capital gains tax is for 1.30 crores. So if you calculate the IRR, even for the post-tax maturity value, you can get an IRR of 10.96%. So these returns surpass inflation, enabling you to build a corpus for your long-term financial goals. So this comparative analysis shows us that separating insurance and investment provides better financial growth. While the SBI Life Smart Elite Plus plan falls short of delivering the desired corpus for your goal, making it less effective than an investment strategy involving pure term insurance and other focused investments according to our risk tolerance. Now, what is the final verdict on the SBI Life Smart Elite Plus plan? Is it worth investing or not? As you can see, the SBI Life Smart Elite Plus plan offers a market linked investment opportunity, but a closer evaluation of this policy reveals to us that its returns fall short compared to other market linked products. The returns do not justify the associated risk, largely due to the plan's high charges. Additionally, the sum assured may be inadequate to meet a family's basic financial needs, potentially disrupting your long term financial planning. So, combining life insurance with market linked investment is not an ideal investment strategy. Overall, the SBI Life Smart Elite Plus plan is not suitable for long term wealth accumulation, and it also has a high agent commission, for which reason you can avoid investing in this policy. Instead, you can opt for a pure term insurance policy, which is a more effective choice for life coverage, providing essential protection for your family. And to achieve your financial goals, it is important to build a diversified investment portfolio across various asset classes, helping you to navigate complex financial conditions.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.